Is there a bigger software loser in the last year than Adobe? The market cannot stand this business right now. In each earnings report, the market drags Adobe through the dirt. Yet, also with each earnings report, Adobe quietly increases revenue, quietly increases earnings, and most importantly, quietly increases cash flow. This is a business leveraging its subscription model to capture new AI-powered growth, and the market simply does not care. A solid business that's just out of favor right now? Or is Adobe's best growth days behind it as it slides into irrelevancy? Welcome to The Quality Investor. On today's video, I want to break down Adobe's earnings release and find out why the stock cannot seem to catch a break. The market claims Adobe is no longer a growth stock, yet at the same time, it is mad that Adobe is no longer growing aggressively. You'll see what I mean in a minute. Adobe fell over 5% after its earnings release. AI hype is driving much of the market sentiment in the short term, especially in the tech sector. But that also means businesses that are failing to meet Wall Street expectations around AI are getting punished for it. That seems to be the case with Adobe. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Adobe now has a PE ratio of 25.1, which is well below the industry median for S&P 500 companies of 34.2. Their price to free cash flow ratio sits at 17.7, also well below the industry median of 29. This is a cheap stock relative to its industry. And even more, Adobe's 10-year PE ratio average is at 50, so their current PE ratio is half of that. My point is that the market is treating Adobe like its growth days are over. A 25 PE for a high margin, high growth tech stock is small. Yet, investors are upset that Adobe isn't raising its guidance aggressively like a high growth stock. The market is primarily upset that Adobe is not monetizing its AI features fast enough, despite Adobe explicitly stating that it is seeking AI adoption over monetization as its strategy in the early stages. See my prior Adobe video linked below. Despite all of this, Adobe had a strong quarter. On this channel, we worry about the actual data and not the hype. And what Adobe's actual numbers are telling us is the future will be perfectly fine. Adobe delivered 11% year-over-year revenue growth. I'll dig into the rest of the financial data and margins shortly. But as far as segment reporting, the all-important digital media segment, which houses the AI offerings, also grew at 11%. The annualized recurring revenue, or ARR, however, grew at 12.1%, now sitting at over $18 billion. Additionally, Adobe raised its guidance for the year for revenue to $23.55 billion at the midpoint, up from $23.43 billion, and raised its adjusted earnings per share guidance to $20.60 at the midpoint, up from $20.35. All of this usually sends a stock higher, but with Adobe, the market thinks it is being left behind in AI. But is it though? Adobe is starting to gain momentum in its AI adoption. Per the earnings call, they claim AI-influenced ARR is tracking ahead of its $250 million target for fiscal year 2025. Its flagship AI app, Firefly, saw 30% quarter-over-quarter growth in the first-time subscribers. Adobe also says AI is driving adoption of Acrobat and Express, its lower market offering geared toward individuals and small businesses. It says users are using AI to analyze documents, which leads to content creation using Express. Adobe is planning deeper integration between Acrobat and Express, thus enhancing its value proposition and moving users from freemium to paid subscriptions. Express now has 50 million monthly active users. Its digital media segment as a whole now has over 700 million monthly active users, up 25% year over year. Overall, Adobe is expressing that high monthly active users, retention, and adoption of AI features, along with a freemium model attracting new users, is supporting a catalyst for long-term revenue growth. In my view, it seems the growth catalysts are there, but the focus for Adobe is truly long-term. First, entrenching users, then monetizing them, rather than monetizing as much as possible in the short term, as Wall Street seems to prefer. I want to quickly dive into Adobe's financial report and review their margin and free cash flow growth. Then I'll assess what I believe is their true share price. But first, I want to address the market concern over increased competition. Slow AI monetization is one reason for Adobe's market slide recently, but increased competition via AI content creation is another. Adobe's core is the creative professional. However, many AI content creation platforms are geared towards that lower market I referenced earlier. Businesses like Canva, which cater to non-professionals and competing with Adobe Express. Express continues to grow its monthly active user base, and Adobe's integration with other tools seems to be winning new clients. Adobe is also partnering with the ad revenue giants such as Google and Meta to aid in AI ad creation and creating marketing journeys. The strategy of if you can't beat them, join them. The 40% year-over-year growth of Adobe Express platform subscription revenue is a positive sign the strategy is working. Another indicator of competitive disruption is in the margins. Is gross margin shrinking? We'll answer that soon. But right now, much of the negative investor sentiment is still in concern that Adobe is being disrupted. In my view, nothing in the numbers is bearing this concern out at this point. Here's the financial statement for Adobe, and you can see on a year-to-date basis, they have $11.587 billion in revenue, which is up 10.5% year-over-year on a year-to-date basis. But what I want to point out here is actually the gross profit, and specifically the gross margin. Year-to-date a year ago, Adobe did $9.3 billion in gross profit, giving them a gross margin of 88.7%, which is incredible. So far, through the first 6 months of fiscal year 2025, Adobe has done $10.3 billion in gross profit, giving them an incredible 89.1% gross margin. I point that out because Adobe continues to expand its margins. Expanding margins is a sign of a business that has a competitive advantage, a wide economic moat, or a dominant market position. So there is a real threat to Adobe from its competitors. I don't deny that. But we're not seeing it show up in the numbers. This is something to keep watching going forward, but Adobe is currently pushing nearly 90% gross margin. And one thing Adobe has started doing is buying back shares at a far faster rate than they have historically. They have bought back 4.6% of their shares in fiscal year of 2025. And we can see in just this quarter alone, they've repurchased $3.5 billion worth of common stock. Adobe also continues to increase its operating cash, a 13% year-over-year increase in this quarter, $2.191 billion this quarter. And once you subtract out that CapEx, that gives Adobe an incredible $2.144 billion in free cash flow. Also a 13% year-over-year increase. Adobe is back on track in generating free cash flow, and that is what we ultimately want to see as investors. More cash into the pockets of investors. And that is what free cash flow is. And Adobe is generating bucket loads of it. The first signs of erosion that we'll see in Adobe if competitors are making true inroads into the core of its business is margin contraction. But as we can see with gross margin and operating margin, both of these very important indicators have trended upwards consistently over the last 10 years. Gross margin now sitting at 89.25% on a trailing 12 basis, and operating margin sitting at 36.37% on a trailing 12 basis. Both of these margins are well higher than their 10-year averages. Another important indicator is the free cash flow margin. It is sitting at 41.75% and back on an upward trajectory after falling a little bit in fiscal year 2023. Adobe is a very capital-light business, and because of that, it doesn't have to reinvest that much back into the business in order to produce growing income. And what that can translate into is a high return on invested capital. So we see the return on invested capital here also consistently growing over the last 10 years, now sitting at a staggering 103.21% on a trailing 12 basis. All of the indicators for Adobe are trending in the correct direction. This is something we want to keep an eye on going forward. We will see margins and ROIC start to decline if their competitors are starting to make major inroads into Adobe's dominant market position. But right now, Adobe is executing on revenue growth, and it's executing on margin expansion, and it's returning cash to shareholders via share buybacks. It's true that the AI monetization has been a little bit slower than what investors have wanted, but it's starting to pick up momentum. And once it does, we should see these numbers get even better and growth starting to accelerate over the next few quarters and years. The real question though is, what's Adobe actually worth right now? Starting with my growth assumptions for revenue, on a total revenue basis, I have the bear case growing at 7.3%, 8.4% on the base case, and 9.5% on the bull case. The digital media segment, however, which is where their AI stuff is housed right now, I have growing at 8% on the bear case, 9% on the base case, and 10% on the bull case. So nothing out of the ordinary in terms of revenue growth. In terms of operating income, their trailing 12 operating margin, like I said, was at 36.37%. And by year 10, I have a bear case operating margin of 37%, 38% for the base case, and 39% for the bull case. Ultimately, though, how much free cash flow will this business generate over the next 10 years? My free cash flow growth rate for the base case is at 9.54%, and that's based on a free cash flow conversion of $1.34, meaning for every $1 of net income, they'll convert a $1.34 into free cash flow. That's below their trailing 12 free cash flow conversion of $1.37. And you can see that my free cash flow margin is actually relatively flat over the next 10 years. Right now, the trailing 12 is at 41.75%, but on the base case, I have it at 40.81%, and on the bull case at 43.89%. I'm not making any crazy projections here for Adobe's free cash flow. In fact, in my view, this is all very modest growth. And we can see here the PEG ratio is falling into, while not an undervalued territory, but a reasonable territory for Adobe on a weighted average here of the bear, base, and bull cases of a 1.91. You can see the projected 10-year growth rates for earnings per share on the bear case at 10.75%, 12.93% on the base case, and 15.17% on the bull case. The forward PE, as we'll see in a second, is at 24.3. Adobe had a pretty decent day in the market, finishing at $401.04. That has pushed its PE ratio now to 25.7 and a forward PE of 24.3. And you can see that both of those are far below their 5 and 10-year averages. I added in this reverse DCF and base case DCF free cash flow growth percentages. The reverse DCF is telling us what the free cash flow growth percent would have to grow at over the next 10 years to justify a $401 share price. Essentially, the market is pricing in 3.78% free cash flow growth per year over the next 10 years. My base case DCF, however, as you just saw, is at 9.54%. So as you'll see here, the market does not have a lot of faith in Adobe growing its free cash flow over the next 10 years. So my DCF bear price is at $551.06, $640.02 on the base case, and $745.32 for the bull case. I have an exit multiple currently at $627.54. My exit multiple comps are Microsoft, Oracle, Synopsys, and Salesforce. And you can see this provides very good upside, even on the bear case for Adobe, 44% on the bear, up to 75.5% on the bull case. So without any margin of safety, I have Adobe sitting at a buy price of $638.31. With a 20% margin of safety, I have it at $510.65, a forward PE of 31. And per my valuation model, it's even trending closer to the 40% margin of safety range, only $18 above $382.98. So in my view, Adobe is a very good buy right now, and I don't believe they'll have any issue hitting 9.5% free cash flow growth over the next 10 years. Their 10-year CAGR historically for free cash flow growth is at about 21%. So this is about half of that. Adobe is a very solid business. It's growing its subscriptions. It's in the very early stages. Remember, the early stages of AI monetization. That will come. It may not be coming as fast as the market wants to see it, but it will come. And if they can stave off the other competition in their lower market tiers with Adobe Express, which so far it seems like they're doing, then I believe Adobe will provide good growth for investors in the years to come. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.